If you are over the age of 60 and you own a car, there are specific costs attached to that car that you are paying every single month, every single year, that you are either legally exempt from, statutorily entitled to have reduced, or qualify to eliminate entirely based on programs, laws, and discounts that exist right now in your state, and that the people collecting those costs have absolutely no financial incentive to tell you about. The average American driver over the age of 60 overpays on driving-related costs by more than $1,800 every single year. Not on gas, not on the car payment, on the fees, premiums, surcharges, and registration costs that sit on top of the car itself, and that most seniors pay automatically, by habit, by renewal, and by assumption. The assumption that the bill they received is the bill they owe. In most cases, that assumption is wrong in at least 3 places simultaneously. There are 7 specific driving costs I am going to walk you through today. 7 costs that seniors across this country are paying right now that they are either fully exempt from, legally entitled to have reduced, or qualify to eliminate based on age, income, or program eligibility that most people have never been told exists. Most seniors are overpaying on at least 4 of them. A significant number are overpaying on all 7. And the one that costs the most, the one I have watched add $600 a year to a retired couple's fixed expenses for a coverage type they stopped needing the moment they retired and that their insurance company will never volunteer to remove. That one is cost number 3. And I promise you, it is not the one you are thinking of. In the next 18 minutes, I am going to show you the specific insurance coverage that most retired seniors are legally overinsured for and the exact conversation to have with your agent to fix it this week. The state-by-state vehicle registration fee exemptions that apply specifically to seniors and veterans, and that your county motor vehicle office will not mention when you renew. The 7 costs one by one, who qualifies to eliminate each one, and the exact steps to claim the reduction or exemption. The 4 words you can say to your insurance agent that immediately trigger a rate review. And the one program available in every state that provides free or deeply reduced transportation to seniors that almost nobody uses because almost nobody knows it exists. If any money is coming out of your bank account automatically for car insurance, vehicle registration, or transportation costs right now, watch this video all the way through. The number I am about to give you is not the number your insurance company advertises. It is the number your insurance company hopes you never calculate. My name is Marcus Graves. I am a consumer protection advocate and senior financial rights consultant who has spent the last 11 years working directly with retirees on fixed and middle incomes to identify and recover overpayments on insurance, government fees, and transportation costs. I have reviewed hundreds of insurance policies, registration bills, and transportation expense records on behalf of real clients, and I sit on the side of the person writing the check, not the company cashing it. I do not work for an insurance company. I do not receive commissions from any insurer, any motor vehicle department, or any transportation program. I work for the people who are paying bills they were never told they could reduce. And here is what I see on senior household expense reviews year after year that nobody in the system has any incentive to correct. Insurance policies priced for driving patterns that stopped applying the day the policyholder retired. Registration fees charged at full rate to seniors who qualify for exemptions that require a single form to activate. Seniors paying for roadside assistance through their insurance when they already have it through 3 other sources they are not using. And transportation costs absorbing a meaningful percentage of a fixed monthly income when free and subsidized alternatives exist within 5 miles of the person's home. Here is why none of this gets corrected automatically. Your insurance company sets your premium based on the information you provided when you last updated your policy. If your driving habits changed significantly when you retired, fewer miles per year, no more commuting, no more driving in peak traffic hours, and you never told your insurer is still pricing your policy as if you are driving the way you were when you were working. They are not going to call you and ask if your habits changed. Every dollar of premium you pay that is higher than your actual risk profile justifies is a dollar of pure additional profit on your account. Your county motor vehicle office processes renewals based on the fee category your vehicle is currently assigned to. If a senior exemption or veteran exemption applies to your registration, it does not apply automatically. You have to file the paperwork to claim it. The motor vehicle office does not review your age, your income, or your veteran status when your renewal arrives. They process the standard fee and send you the bill. If you pay it without claiming your exemption, they keep the money and the exemption goes unclaimed until you file. I want to be clear before we go further about who this video is for. It is for both groups of senior drivers. For the retiree on a fixed income where every dollar of monthly expense matters, several of the costs I am going to describe can be eliminated entirely with a phone call or a one-page form. For the comfortable retiree with savings and a pension who drives a newer vehicle and carries full coverage, the optimization I am going to describe on your insurance policy alone can save $400 to $800 per year without reducing your actual protection by a single dollar of coverage that you need. The driving cost overcharges hit both groups, just in different places. Before I get into the 7 costs, I want to tell you about a client of mine. I am going to change his name. I will call him Harold. Harold is 74 years old. He is a retired postal worker from outside of Kansas City, Missouri. He worked for the United States Postal Service for 31 years. He has a federal pension, a paid-off house, a 2019 sedan that he keeps immaculately, and a driving record with no accidents and no violations going back to 1,987. He drives approximately 4,200 miles per year. He goes to the grocery store, to church, to his doctor, and to his daughter's house 12 miles away. He has not driven in rush-hour traffic since the Friday before he retired in 2018. Harold is not reckless with money. Harold is meticulous. He has a filing cabinet. He keeps every receipt. He reviews his bank statement every month. He is the kind of person who notices a $4 error on a restaurant bill and mentions it politely to the server. Harold has had the same car insurance policy with the same company since 2014. He reviews it every year at renewal. He checks the premium, confirms the coverage types are the same as the prior year, and pays the bill. In 2023, his annual premium was $1,847. He thought that was reasonable for a 74-year-old driver. He had heard that insurance gets more expensive as you get older, and he assumed the number reflected his age and his vehicle and the cost of coverage in Missouri. What Harold did not know, what his insurance company had not told him, what his renewal notice did not mention, what the agent he called to make a minor address update 2 years earlier had not volunteered, was that Harold qualified for 4 separate discounts on his current policy that had never been applied. A low-mileage discount for driving under 7,500 miles per year. A mature driver discount for completing a state-approved defensive driving course for seniors. A retired federal employee discount available through his insurer's affinity program. And a usage-based insurance option that would have replaced his standard premium with a premium calculated directly from his actual driving behavior, which given his 4,200 annual miles and his spotless record would have been significantly lower than the flat rate he had been paying for 9 years. Harold also did not know that Missouri offers a vehicle registration fee reduction for residents over 65 with income below a specific threshold, and that as a pension recipient whose total annual income fell below that threshold, he had been eligible for that reduction since he turned 65. He had been paying the full registration fee for 9 years. And Harold did not know that the roadside assistance coverage he had been paying for as a line item on his insurance policy, $47 per year, was completely duplicative. His federal employee retiree benefits included roadside assistance. His credit card included roadside assistance. And his vehicle's manufacturer warranty, which was still active on his 2019 sedan under an extended program he had purchased and forgotten about, also included roadside assistance. Harold was paying for the same service 3 times and collecting it 0 times because he had never needed to use it. Harold came to me because his daughter had seen content online about senior insurance discounts and had printed it out and left it on his kitchen table. Not because his insurance company called, not because the motor vehicle office sent a notice, because his daughter left a printout on his table. We went through Harold's full driving expense picture in one 2-hour appointment. What we found changed his annual driving costs in ways he had not thought possible without changing his coverage, changing his car, or changing his driving habits at all. I am going to tell you exactly what we found and exactly how we found it. But I want to get through all 7 costs first because Harold's situation was not unusual. It was typical. Cost number 1, the standard insurance premium charged to a driver whose habits changed at retirement. This is the most widespread senior driving overcharge in America, and it is the one your insurance company is least likely to bring to your attention because correcting it directly reduces their revenue from your account. When you were working, your insurance company priced your policy based on a profile that included your annual mileage, your commuting pattern, the times of day you typically drove, and the geographic areas you regularly traveled through. Rush hour commuting, highway driving, and high-traffic urban routes all increase actuarial risk and therefore increase premium. That profile was accurate when you were working. It has not been accurate since the day you retired. The average American worker drives between 12,000 and 15,000 miles per year while employed. The average retired American drives between 4,000 and 7,000 miles per year. That difference in annual mileage represents a meaningful reduction in statistical risk that actuarially justifies a lower premium. Your insurance company knows this. They will apply it to your premium if you ask them to update your mileage. They will not update it if you do not ask. The action is to call your insurance agent or your insurer's customer service line and request a policy review based on your current annual mileage. Before you call, calculate your actual annual mileage by looking at your last 2 or 3 oil change receipts or your vehicle inspection records, which show the odometer reading at each service. Divide the mileage difference by the time elapsed, and you have your annual mileage. If your annual mileage is below 7,500, ask specifically about a low mileage discount. If it is below 5,000, ask about usage-based insurance programs, which use a small device plugged into your vehicle or a smartphone app to track your actual driving and price your premium based on real behavior rather than statistical averages. For a retired senior driving 4,000 to 5,000 miles per year with a clean record, usage-based insurance routinely produces premium reductions of 20 to 40% compared to the standard rate. For the fixed-income retiree, a 30% reduction on a $1,400 annual premium is $420 back in your pocket every year. For the comfortable retiree carrying full coverage on a newer vehicle with a higher base premium, the same percentage reduction on a $2,200 premium is $660 per year. In both cases, your coverage does not change. Your risk profile does not change. Only the accuracy of the information your insurer is using to price your policy changes. Cost number 2, the mature driver course discount that your insurer offers and has never mentioned. Every major auto insurer operating in the United States offers a discount for senior drivers who complete a state-approved defensive driving or mature driver improvement course. The discount ranges from 5 to 15% of your base premium depending on the insurer and the state. The discount is typically applied for 3 years after course completion and can be renewed by taking the course again. The courses are offered by AARP, by AAA, by the National Safety Council, and by state-approved providers in every state. The AARP Smart Driver course, the most widely recognized, is available online for $19.95 for AARP members and $24.95 for non-members. It takes approximately 6 hours to complete and can be done over multiple sessions from your home computer. Upon completion, you receive a certificate that you submit to your insurer to activate the discount. At a 10% discount on a $1,600 annual premium, the course saves you $160 per year for 3 years, $480 in total savings on a $25 investment. The return on that investment over 3 years is approximately 1,800%. Your insurer knows this discount exists. Your insurer is not required to tell you about it. They are required to apply it when you submit the certificate. The action is to call your insurer today and ask 2 questions. Do you offer a mature driver or defensive driving discount? And what is the approved course list for my state? Then go to aarp.org/driversafety or aaa.com/drivercourses, complete the appropriate course, and submit your certificate. The discount is applied at your next renewal, or in some cases immediately upon receipt of the certificate, depending on your insurer's policy. For the fixed-income retiree, this discount combined with the low-mileage discount from cost number 1 can reduce an annual premium by $300 to $500 without changing a single element of your coverage. For the comfortable retiree, the same combination on a higher base premium produces proportionally larger savings and takes the same 6 hours and the same phone call to activate. Cost number 3, the coverage type that most retired seniors are carrying and no longer need. This is the cost I mentioned at the beginning of this video. This is the one that has added $600 a year to retired couples' fixed expenses for coverage they stopped needing the moment they retired. And this is the one your insurance company will never volunteer to remove because it is one of the higher margin line items on your policy. The coverage is called rental reimbursement coverage. It pays for a rental car while your vehicle is being repaired after a covered accident. It costs between $30 and $80 per year on most policies and sounds entirely reasonable when you are working and your car is your primary means of getting to a job every day. When your vehicle is in the shop for a week, a rental car is not a luxury. It is a necessity. When you are retired, the calculus is completely different. You are not commuting. You do not have a job to get to. If your car is in the shop for a week, your daughter can drive you to your medical appointments. Your neighbor can take you to the grocery store. Public transit, ride-sharing, or simply rescheduling non-urgent errands for the week your car is unavailable are all viable options that were not viable when missing work had financial consequences. Rental reimbursement coverage on a retired senior's policy is in most cases pure premium with zero practical benefit. It exists on the policy because it was added when the policyholder was working and has renewed automatically every year since without anyone asking whether the need still exists. Beyond rental reimbursement, there are two additional coverage types worth reviewing for retired seniors who own an older vehicle outright with no financing. Collision coverage pays for damage to your own vehicle in an accident, regardless of fault. Comprehensive coverage pays for non-collision damage, theft, weather, fire, falling objects. Both are valuable and often essential when you are financing a vehicle because the lender requires them. When you own the vehicle outright and the vehicle's market value has declined significantly, the math on whether the annual premium cost justifies the maximum possible payout changes. The standard rule used by consumer finance experts is this: if your annual collision and comprehensive premium combined exceeds 10% of your vehicle's current market value, you are likely paying more in premium than you would collect in the event of a total loss after your deductible. On a vehicle worth $8,000, 10% is $800. If your combined collision and comprehensive premium is above $800 per year and your deductible is $1,000, a total loss would net you $7,000 from the insurer on a policy costing you $800 per year. That math deserves a hard look. The action is to pull your current policy declarations page, the summary page that lists every coverage type and its cost, and go through it line by line. Identify rental reimbursement coverage and ask your agent to remove it at your next renewal if you are retired and have alternative transportation options. Then look up your vehicle's current market value at kbb.com or edmunds.com, calculate 10% of that value, and compare it to your combined collision and comprehensive annual premium. Cost number 4. The vehicle registration fee exemption your state offers and your county office will not mention. Vehicle registration fees are collected by state and county motor vehicle offices, and they vary significantly by state, by vehicle type, and by vehicle age. What most seniors do not know is that a significant number of states offer registration fee reductions, exemptions, or caps specifically for senior residents, disabled veterans, low-income residents, or residents over a certain age regardless of income. The exemptions vary by state in both their eligibility requirements and their dollar value. Some states exempt qualifying seniors from the full registration fee. Some cap the fee at a reduced flat amount. Some offer a reduction based on vehicle age. Older vehicles carry lower registration fees in most states, and a vehicle over a certain age may qualify for an antique or classic vehicle registration at a significantly reduced rate that also comes with usage restrictions. States with documented senior or income-based registration relief programs include, but are not limited to California, which offers a reduced fee for low-income seniors through the Department of Motor Vehicles Assistance Program. Florida, which exempts certain disabled veterans from registration fees entirely. Texas, which offers registration exemptions for disabled veterans and certain qualifying disabled residents. Virginia, which offers registration fee waivers for certain disabled veterans. And Pennsylvania, which offers reduced fees for vehicles owned by residents receiving specific income-based assistance. The eligibility thresholds, application processes, and benefit amounts for each of these programs change periodically and vary by county within states, which is why the single most important action is a direct phone call to your county motor vehicle office asking 2 specific questions. What senior, veteran, or income-based registration fee reductions are available in this county? And what documentation do I need to apply? That phone call takes 4 minutes. The answer either confirms you are paying the correct amount or identifies an exemption you have been missing. In states with full fee exemptions for qualifying residents, the annual savings can range from $80 to $300, depending on the vehicle and the registration jurisdiction. For the fixed-income retiree, a registration fee exemption on top of the insurance savings from costs 1 through 3 can meaningfully reduce a monthly budget line that had seemed fixed and unavoidable. For the comfortable retiree who is also a veteran, the combination of veteran registration exemptions and the insurance optimizations already described can produce total annual driving cost reductions of $800 to $1,200 without changing any aspect of how or where you drive. Cost number 5, the duplicate roadside assistance coverage you are paying for multiple times. This is the cost that surprises people the most when they see it laid out clearly because it is not a single charge. It is the same charge appearing in 3 or 4 different places simultaneously, each one billed separately, each one paid automatically, and none of them ever used because most drivers with roadside assistance go years without needing it. Roadside assistance covers towing, jump starts, flat tire changes, lockout service, and fuel delivery. It is a genuinely valuable service when you need it. It is a genuinely wasteful expense when you are paying for it 4 times and collecting it 0 times. The 4 places roadside assistance most commonly appears simultaneously on a senior's expense profile are these. As a line item on your auto insurance policy, typically costing between $30 and $60 per year. As part of an AAA membership, which costs between $60 and $120 per year, and whose primary value proposition for many members is the roadside assistance component. As a benefit included with a credit card, specifically, cards issued by Chase, Citibank, American Express, and several other major issuers include roadside assistance as a standard cardholder benefit at no additional charge. And as a benefit included in a vehicle manufacturer's warranty program or a dealer-sold extended warranty, both of which typically include roadside assistance for the coverage period. A senior who has all 4 of these simultaneously is paying between $90 and $180 per year for roadside coverage they could access for free through their credit card or their warranty if they simply knew those benefits existed and canceled the paid versions. The action is to check 4 things before your next renewal. Pull your auto insurance declarations page and find the roadside assistance line item and its annual cost. Check your AAA membership benefits and confirm whether roadside assistance is the primary reason you maintain the membership or whether you are using other AAA benefits, travel discounts, map services, notary services that justify the membership independently. Call the customer service number on the back of your primary credit card and ask whether your card includes roadside assistance and what the coverage limits are. And check your vehicle's warranty documentation, or call your dealer to confirm whether manufacturer or extended warranty roadside assistance is still active. Once you know which sources of roadside coverage you have, cancel the paid versions that are redundant. Keep whichever single source provides the best coverage for your situation. The savings are modest individually, but they are entirely unnecessary expenses that disappear with one cancellation call. Cost number 6, the affinity and group discounts your insurer offers through organizations you already belong to. This is the discount category that most seniors leave unclaimed, not because they are ineligible, but because nobody connects the membership they already have to the insurance discount it qualifies them for. Major auto insurers offer discounted rates through affinity programs, negotiated group discount arrangements with specific organizations whose members receive preferred pricing on insurance products. The organizations that most commonly have affinity arrangements with major insurers include AARP, AAA, Federal Employee and Retiree Associations, military and veteran organizations including USAA, the American Legion, and the Veterans of Foreign Wars, teachers' unions and retired educators associations, and labor unions and their retiree affiliate organizations. If you are a member of any of these organizations, or if you were a member during your working years and have maintained your membership or alumni status, you may qualify for a group discount on your auto insurance that is not automatically applied to your existing policy, even if you are already insured with a company that has an affinity arrangement with your organization. The discount amounts vary by insurer and by organization, but typically range from 5 to 12% of the base premium. On a $1,600 annual premium, a 10% affinity discount is $160 per year. Combined with the low mileage discount, the mature driver course discount, and the coverage optimization from costs 1 through 3, the cumulative annual savings on a single insurance policy can reach $500 to $900 without any reduction in meaningful coverage. The action is to make a list of every organization you currently belong to or have belonged to in the last 5 years. unions, professional associations, veteran organizations, retiree groups, alumni associations, and call your current insurer to ask whether any of those memberships qualify for an affinity discount on your current policy. Then call 2 or 3 competing insurers and ask the same question. The combination of affinity discount plus competitive shopping produces the largest single-year premium reduction available to most senior drivers. Cost number 7. The transportation costs you are paying out of pocket when free and subsidized alternatives exist. This final cost is different from the first 6 because it is not about reducing a bill you are already paying to an insurer or a government office. It is about eliminating trips in your personal vehicle, and therefore eliminating fuel costs, mileage wear on your vehicle, and the associated insurance risk exposure by using transportation alternatives that are funded specifically for senior use and that exist in virtually every county in the United States. The Federal Older Americans Act, first passed in 1965 and reauthorized most recently in 2020, provides dedicated federal funding to area agencies on aging in every county in the country. A portion of that funding in every jurisdiction goes to senior transportation programs, free or very low-cost transportation services for residents over 60 for medical appointments, grocery shopping, pharmacy visits, and other essential errands. These programs operate under different names in different counties. Some are called senior ride programs. Some operate through local transit authorities with free or reduced fare senior passes. Some are demand-responsive services where you call and schedule a ride. Some use volunteer driver networks. Some contract with ride-sharing services to provide subsidized rides specifically for senior residents. In addition to the Older Americans Act programs, every state transit authority in the United States offers reduced fare or free transit passes for residents over a certain age, typically 65, and for disabled residents regardless of age. In major metropolitan areas, those passes provide access to bus, rail, and subway systems at half fare or no fare. In rural areas, the equivalent programs typically operate as dial-a-ride or scheduled route services rather than fixed-route transit. The action is to call your local area agency on aging. To find your local agency, go to eldercare.acl.gov and enter your zip code. Ask 2 questions. What free or reduced cost transportation programs are available to residents over 60 in this county? And what do I need to provide to enroll? For the fixed-income retiree who is currently driving to every medical appointment, every pharmacy trip, and every grocery run in their personal vehicle, enrolling in a senior transportation program and using it for routine errands can reduce annual fuel costs by $200 to $600 and reduce annual mileage on the vehicle by 1,000 to 2,000 miles, which in turn supports the low mileage insurance discount from cost number 1 and reduces wear-related maintenance costs simultaneously. For the comfortable retiree who does not need the free transportation for financial reasons, the same programs offer a safety net for the period, which comes for most drivers eventually. When driving becomes less comfortable or less advisable, and having an established relationship with an alternative transportation provider makes the transition easier and less disruptive. There are 3 specific situations where driving cost overcharges compound the fastest and that I want you to know about before you make any of these changes. The first is the year you turn 65. That is the year most senior-specific discounts, exemptions, and program eligibilities activate. Your insurance company does not send you a letter when you turn 65 saying you now qualify for a mature driver discount. Your motor vehicle office does not flag your account when you turn 65 and apply any available exemption. Your area agency on aging does not knock on your door. Every one of these benefits activates only when you claim it, and the claiming requires you to know it exists. If you turned 65 in the last 5 years and have not reviewed your driving costs since then, the review I am describing in this video is overdue. The second is the year you pay off your car. The moment a vehicle is owned outright with no financing, the lender's requirement for collision and comprehensive coverage disappears. Many drivers continue carrying that coverage out of habit long after the loan is paid off, paying premium on coverage that is no longer required and that may no longer be financially rational given the vehicle's depreciated value. The payoff date of your vehicle is the trigger for the coverage review described in cost number 3. If you paid off a vehicle in the last 3 years and have not reviewed your collision and comprehensive coverage since the payoff, that review belongs on your calendar this week. The third is the year a spouse stops driving. When a spouse passes away or stops driving due to health or preference, the household goes from a 2-driver household to a 1-driver household. That change reduces the statistical risk on the policy and should reduce the premium. But it only reduces the premium if you notify your insurer and request a policy update. An insurer who has two named drivers on a policy and is not told that one of them no longer drives will continue pricing the policy as a two-driver household indefinitely. The notification is a phone call. The premium reduction is a result of information the insurer needs you to provide. Harold's full driving cost review produced changes across 5 of the 7 categories. His insurer updated his annual mileage to 4,200 miles. The low mileage discount reduced his premium by $187 per year. Harold completed the AARP Smart Driver course online over 2 evenings. The mature driver discount reduced his premium by an additional $164 per year. Harold's rental reimbursement coverage was removed from his policy at the next renewal, a saving of $54 per year. His insurer confirmed a federal employee retiree affinity discount that had never been applied to his account, despite his insurer having an affinity arrangement with the Federal Retiree Association Harold had belonged to for 6 years. That discount reduced his premium by an additional $143 per year. The roadside assistance line item on his insurance policy was cancelled. Harold confirmed that his credit card included roadside assistance as a standard benefit and that his vehicle's extended warranty, which he had purchased and genuinely forgotten about, also included it. He kept the credit card benefit as his primary source and cancelled the insurance add-on, saving $47 per year. Harold's total annual auto insurance savings across all changes, $595 per year on a policy that previously cost $1,847. His new annual premium, $1,252. His coverage did not decrease in any way that affected his actual protection given his driving profile. Harold also called his county motor vehicle office and confirmed that Missouri does not currently offer a broad senior registration exemption at the state level, but that his specific county had a program for residents with income below a certain threshold. His pension income placed him just below that threshold. He filed the one-page application. His registration fee dropped from $51.50 to $18.50 per year, and Harold's daughter helped him enroll in his county's senior ride program through the local area agency on aging. Harold now uses the program for his medical appointments and his pharmacy runs, approximately 8 to 10 trips per month that he previously made in his own vehicle. His estimated annual mileage for next year is projected at 2,800 miles, which will qualify him for an even deeper low-mileage discount at his next renewal. He told me the thing that stayed with him was not the $628 in annual savings, though on a fixed pension income $628 is 2 months of grocery money. It was the phone calls. He said every single change came down to a phone call that he had never known to make. His insurer did not call him. His motor vehicle office did not call him. His area agency on aging had no idea he existed until his daughter helped him find their number. He said the system was not designed against him. It was just designed around the assumption that he already knew what he was entitled to. And for 9 years, he had not known. So for 9 years, he had paid as if he did not. He said if there is one thing he would tell someone sitting where he was sitting a year ago, it is this. The discount exists. The exemption exists. The program exists. They have existed for years. The only thing that was missing was the phone call. And the phone call takes 4 minutes. If you take one number away from this video, take this one, $1,800. That is what the average senior driver overpays on driving-related costs every single year on expenses that are either reducible, exemptable, or eliminable based on programs and discounts that already exist and are already funded and are already waiting to be claimed. Not because the system is designed to cheat you, because the system is designed to process what you submit and charge what you have agreed to pay. The optimization is not automatic. It is a choice. And it is a choice you can make this week with a series of phone calls that cost nothing. Your insurance company is not going to call you and apply your low mileage discount. Your county motor vehicle office is not going to flag your account and apply your senior exemption. Your area agency on aging does not know your name. The only person who can make these calls, claim these discounts, and put this money back in your pocket is you. Send this video to one person you love who is over 60 and owns a car. It does not matter whether they are on a tight fixed income or living comfortably on a pension and savings. The overcharges I described today are sitting on policies and registration bills at every income level. And one share from you could put $1,800 back in their pocket next year for nothing more than a series of 4-minute phone calls they did not know they needed to make. That is what this channel is here to do. I will see you in the next.